Hello, my name is Chris Fensky and I lead capital markets research for S&P Global Market Intelligence's primary markets group. Major U.S. energy and debt indices proved extremely resilient last year, with both asset classes still managing to post positive returns in 2025, despite a 20% decline in U.S. crude oil prices. For starters, the S&P 500 Energy Select Index reported a total return of 8.7% in 2025. However, that was less than half of the S&P 500's 17.9% total return during the year, which was largely driven by the technology sector's 24% gain. Energy high-yield debt indices also ended the year in positive territory, with the iBoxx USD Liquid High-Yield Oil and Gas Index printing a total return of 6.8% in 2025, albeit that is still well below the 9% return for the iBoxx USD Liquid High-Yield Index that excludes oil and gas debt. Investors have kicked off this year by refocusing their attention on U.S. equities and debt from the energy sector, with the S&P 500 Energy Select Index being the best performing sub-index so far this year, returning 21.3% as of mid-February versus the S&P 500 being close to unchanged. Going all the way back to 2000, that same energy sub-index had its second best January performance this year at 14.4% on the month, after January 2022's 19% return. The AI build-out has been a major driver of the energy sector's outperformance this year, with concerns over AI disrupting some software business models pressuring equities from that part of the technology sector and nudging investors towards the natural resource producers required for building and operating data centers. Natural gas is being viewed as a beneficiary of the build-out in AI data centers from the increased power requirements, while geopolitical concerns over supply disruptions from major oil producers Iran and Russia are providing some support for oil prices. On the debt side, the iBoxx USD Liquid High-Yield Oil and Gas Index has returned 2.1% as of mid-February versus 0.6% for the index that excludes oil and gas debt. The surge in AI-related technology debt issuance has been pressuring that sector's bond prices through wider spreads, and there is some shift by investors into corporate bonds from the energy sector. Technology bond issues made up approximately 22% of non-financial U.S. corporate bond issuance in 2025 versus only 12% from energy companies, with 2026 technology issuance already near 40% of all U.S. issuance as of mid-February. In the case of high-yield corporate bonds, the impact is becoming apparent in bond yields, as average energy debt borrowing costs were 68 basis points higher than non-energy debt last May. Those same energy bonds' average yields are 6.14% as of mid-February, which is actually 77 basis points lower than non-energy companies' debt. In conclusion, equity market volatility will likely remain somewhat elevated in the near term as investors continue to assess how the progress being made in the AI build-out could impact the growth prospects for businesses that could potentially be disrupted by those innovations. Energy debt markets should remain relatively stable barring any sharp declines in oil and gas prices driven by a tapering off of geopolitical concerns or a significant uptick in market volatility. The lead up to the U.S. midterm elections in November has the potential to make investors approach the second half of the year with a more balanced approach to sector allocations until the final results for the U.S. House and Senate votes provide more clarity on the path of U.S. policy.